I have a bit of a philosophical question for you. Hypothetically, if I said that I could give you a guaranteed $50,000 a year inflation-adjusted income for life starting today, would you take it? What if I altered the opportunity by handing you a simple 6-sided dice and said that if you roll a 6, I will give you a $300,000 a year inflation-adjusted income instead of the $50,000 income, but if the dice lands on any other number, you will get nothing. What would you do then? It's interesting because from an expected value standpoint, the two options are exactly equal. You have a 1 in 6 chance of getting a $300,000 a year income by rolling the dice. This means that the expected value of making that choice is $50,000 per year in income. The same is true if you take the guaranteed $50,000 per year income. But if previous research is to be believed, most people would take the guaranteed $50,000 a year because the potential perceived loss of ending up with nothing outweighs the potential benefits, from a psychological perspective, of gaining that $300,000 a year income. This tendency to feel losses, whether perceived or actual, greater than gains is often referred to as loss aversion. Now, there are people who are known as loss neutral or even risk-seeking. Those who are loss neutral may look at the previous hypothetical and say that both choices are equally valid, because from a mathematical perspective, the expected values are the same. Those who are risk-seeking may opt to roll the dice for the chance at the $300,000 income, despite the fact that the decision may end up leaving them with nothing. But what's even more interesting is that depending on our situations at the time these choices with differing levels of risk are presented to us, we may find ourselves at different points along the risk spectrum. For instance, someone living on a very tight budget out of necessity as opposed to choice is probably going to be a lot more loss-averse than someone with millions and millions of dollars stashed away in various investments that are already providing them with more than enough income to live off of. What's also interesting is that both of those individuals are taking risks, and possibly a lot more of it than we would intuitively assume, because the risk spectrum, at least when it comes to personal finance, isn't some sort of linear function where risk starts off incredibly small but then gets progressively larger as you move from one strategy or investment to the next. It's actually a lot more quadratic. Some of the safest investments have very large risks when we stop to examine them closely, while typically more volatile investments may actually have comparatively lower risks. And that's what we're going to be talking about today. Today we're going to be discussing the risk spectrum of personal finance. We'll be examining where various investments fall onto the spectrum, how various strategies affect those placements, and how you can move across the spectrum yourself over time. Let's get started. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a 30-day free trial of Audible and 2 free audiobooks of your choice, as well as a list of some books on money I'd recommend checking out with your free trial. So I have another question for you. What is the point of investing our money? Why do we do it, really? Well, the answer will obviously differ from person to person here, but I can tell you the main reason why I do it. It's to allow my money to work for me, long and hard enough that I, at some point in the future, can have enough to support me and my family should I either become incapable of doing it through my own labor or just decide that I don't want to anymore. In other words, on a fundamental level, the primary reason I invest is to one day reach financial independence. Therefore, with very few exceptions, my personal investing decisions and the amount of risk I see in the various strategies are going to be viewed through that lens. With that in mind, let's take a quick look at 3 different types of investments: money market funds, bonds, and stocks. From the perspective of investing for financial independence, which is actually the riskiest investment? The money market fund has the very notable pro of being an investment that is highly unlikely to lose money. However, the trade-off is that the returns on your investment are usually very, very low compared to other types of investments. Let's say that John invests 10% of his income, or $500 a month, into a money market fund that's paying him 2% interest. Assuming this is his only investment, which hopefully it's not, but assuming it is, it means that he's living on the other 90% of his income, or $4,500 a month in this case. Therefore, in order to reach financial independence, he will need to have $1,350,000 put away. At this rate, it'll take John nearly 86 years to build up that kind of money. That's longer than the average human lifespan. So unless something about his situation changes in the future, he's dealing with an insanely high risk of outliving his savings. And that's not even factoring in things like inflation. Hypothetically, if John's personal inflation rate was 3% per year, he would actually never reach financial independence, despite the fact that he's saving more money every single month. That's how a seemingly very low-risk investment can actually be pretty risky when looked at closely. Next, let's assume John invested solely in bonds. Historically speaking, bonds have been far less volatile than stocks, though there is always some risk of default, so they generally are seen as riskier than something like a savings account or money market fund would be. However, due to the increased amount of perceived risk, they tend to have higher average returns over the long haul. Let's say that over his career, John's ROI on his bonds was 5% per year, and 2% after adjusting for inflation. Under these assumptions, John would become financially independent in about 51 years from a nominal perspective, or about 86 years in today's dollars. On the one hand, that's great. At least this time John does in fact achieve financial independence eventually. That'll bring bonds a little further down the risk curve for John, but on the other hand, depending on his age and when he started investing, and the goals he has, it's likely a lot later than he would have wanted to reach financial independence. He is still likely running the risk of dying before becoming financially independent and reaping the rewards in his golden years. Stocks continue this trend down the curve. Despite their comparatively higher volatility in the short term than bonds, they also come with generally larger returns over the long run. For instance, the S&P 500 has averaged returns of around 10% per year before adjusting for inflation throughout its history. Hypothetically, this would mean that John could achieve financial independence in about 42 years, even after adjusting for inflation. It's not a no-risk investment because he may find himself in a situation where he needs to withdraw the money at a time when the market is down, either because of a job loss or some other calamity, but long-term, it's probably less risky from a financial independence perspective than bonds or money market funds. However, I also said that investments can move along the spectrum and become either more or less risky depending on the strategies we use when buying them. So let's discuss a few ways that you can increase or decrease the risk of your investments. One of the biggest ways to increase the risk of your investments is to leverage them. It's one thing to invest in stocks, which can be volatile, especially over the short term. But even in the worst case scenario, a stock will only ever fall to zero. However, if you've leveraged your investments in stocks, or any investment for that matter, you can fall below zero even if the investment itself doesn't. This is something that happened to a lot of people in the real estate market during the Great Recession, which is not to say that leverage is always going to result in a negative outcome. As we've covered in the past, leverage can significantly magnify your returns, both positively and negatively. For instance, say John had $30,000 to play around with. He used it to buy a $300,000 home, which obviously means this will be a leveraged investment because he's using other people's money to fund $270,000 worth of his $300,000 investment. His mortgage is for 30 years and he's paying 4% in interest. 10 years later, he sells the home for $600,000. Under a normal, non-leveraged investment, where John footed the entire $300,000 himself, this would mean that he made about 7.2% per year over those 10 years. However, because this is a leveraged investment, the calculations aren't that straightforward. John's monthly mortgage payment would be $1,289. Over the course of 10 years, that would have amounted to about $154,700 in payments. At the point that he sold his home, the balance of his mortgage would be about $213,000. Since he sold his home for the $600,000, that means that he would keep $387,000 after paying off the rest of his mortgage. Take away the $154,700 he had to pay to keep the investment for those 10 years, and we're left with $232,300. Excluding any maintenance and repair and renovation costs, we're ignoring those for now. So over the course of 10 years, John's original $30,000 out-of-pocket investment grew to $232,300. Therefore, his effective annualized return would have been about 22.7% per year instead of 7.2%, which is great. However, if the value of his home didn't grow that fast, or even worse, went down, things would have been very different. Say instead of rising to $600,000, the value of John's home fell to $250,000. Thankfully, John isn't totally underwater as a lot of people were during the Great Recession, but he's not doing that great either. He decides to sell his home and pay off the remaining $213,000 on his mortgage. On its face, this still leaves him with a $37,000 gain. But since he had to pay $154,700 to maintain the investment over the last decade, you could argue that he actually lost money, and quite a lot of it too. His overall net worth certainly would take a hit from this, and that'll make it harder for him to eventually reach financial independence. The same general principle applies when trading on margin with stocks, or any other type of investment where other people's money is involved. If things go well, your gains, whatever they may be, can be magnified, but so can your losses. And since those losses don't actually have to stop at zero, the risk is greater from a financial independence perspective. One of the best ways to lower your risk of investments is to diversify them. We already sort of touched on this earlier when we were talking about investing in something like the S&P 500 index funds, which is considerably more diversified than an individual stock is. However, you could go further than that if you wanted to within your stock market investments. You could give yourself some internationally focused index funds to round out some of the more US-focused S&P 500 funds. You could also look at some index funds that track mid-sized or smaller companies, since the S&P 500 is largely focused on the bigger, more established companies. Beyond diversifying in the stock market, you could put some of your nest egg into other investment classes, such as bonds. Doing this generally does lower your expected returns, as we've covered in previous videos, but the comparatively smoother ride over the years could be well worth it. The last thing that I wanted to touch on today is how you can move yourself along the investment risk spectrum. Because we've seen now how even the seemingly safest investments can actually be quite risky down the road. However, that doesn't necessarily make it any easier for someone new to investing to get comfortable with investing their hard-earned dollars into something that's as risky as some investments like stocks can be. In my mind, there are three main ways to help yourself get more comfortable with the idea of investing in a more traditionally volatile investment class, and thus move yourself along the spectrum. First, you can broaden your investing knowledge base. When you learn more about how certain investments work, you'll get a better idea of what to expect day to day, week to week, month to month, and so on. And over time, you'll get a better sense for what's normal and what's actually worth panicking over. It's one thing to hear that something like the S&P 500 has averaged 10% per year over the last X amount of years. That's a great thing to know, but it doesn't really give you a picture of what the experience of investing in something like the S&P 500 could be like. However, if you were to look into the history of the S&P 500, you'd see that in any given year, it might earn 30% or more, or lose just as much, and it paints a much clearer picture. However, as we saw in my video on what to expect when investing in the stock market, which I'll leave a link to in the description below if you haven't seen it yet, most years are going to fall somewhere in between the 5% loss and 25% gain brackets. And in fact, there were more years that gained at least 20% or more than there were years that lost anything at all. In your research, you'd also find that the market did recover from every single one of those years that lost money. Sometimes it did take a handful of years, and others it was recovered in a matter of months, but it did always recover. You'd also learn that those years when the market does lose money is an opportunity for investors that are willing and able to stay in and buy more shares, because the value of their portfolio is going to grow exponentially when the market eventually recovers. I refer to this as the investing slingshot effect, and we covered this on my video on what to do when the stock market crashes, which I'll also link in the description below. Another thing that you can do to increase your investing risk tolerance is to have an emergency fund and work on diversifying your income streams. This is simply because it'll make you much more resilient should something undesirable happen that's outside of your control, such as a job loss or a market crash. Think about it. If your only source of income is your paycheck, then it makes it much more likely that you will, at some point, have to temporarily live off your savings or investments. As a result, it's often tougher to put the bulk of that savings into those investments that are volatile over the short term. Having a fully funded emergency fund will help to alleviate these concerns, especially when it comes to those shorter-term, temporary setbacks. Having multiple streams of income will help make you more comfortable in the event of a longer-term setback. It also often helps out with the third most common way to move yourself across the investment risk spectrum, because the third way to move yourself across the spectrum is to build a large net worth in relation to your expenses. Obviously, like I said, someone living on $40,000 a year with a $10 million nest egg is going to be able to take on more risks than someone living on that same $40,000 a year but with a $10,000 nest egg. And this one obviously takes time to really have an impact, but I felt it was still worth noting. So those are some of my thoughts on the investment risk spectrum and how to manage it. What do you think? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.